Oil is up nearly 12% this week, yet the US dollar index is still on track to finish the week down about 0.24%. That looks backwards because war risk, oil and inflation fear usually support the dollar. But the market is not pricing one event on one clock. The real question is which risk each asset is pricing and when. Oil is pricing the physical shock first. Reuters reported Brent near $84.93 TESs and WTI near $79.76 as fighting around key Gulf routes increased the risk of supply disruption. That premium appears quickly because physical supply is exposed now. The dollar is more sensitive to the expected US rate path relative to other economies. The latest inflation report cooled the front end of that path. The Bureau of Labor Statistics said June headline CPI fell 0.4% month over month, while core CPI was unchanged and the annual core rate slowed to 2.6%. After that report, Reuters said the probability of a July Fed hike fell to 11%, down from 25% 1 week earlier. So the weekly dollar move is not ignoring oil, it is discounting a lower chance of an immediate policy response. That does not mean the Fed has turned dovish or that inflation risk has disappeared. Reuters separately reported that traders still assigned a 73% chance to a December rate increase, while Dallas Fed President Lori Logan argued that rates may need to move modestly higher. Gold was also heading for a 3.4% weekly loss, despite the geopolitical stress, another sign that this is not a simple safe haven trade. Markets are separating July from December, and immediate supply risk from later policy risk. Confirmation would be oil holding its weekly surge, while the dollar and the 2-year Treasury yield fail to make matching weekly highs. Invalidation would be the dollar reversing to a weekly gain, July hike odds rebuilding sharply, or supply risk easing enough to pull crude back down. The next watch points are DXY, Brent, the 2-year yield, and the gap between July and December rate probabilities. If those measures start moving together, the market is shifting from a timing split toward a broader inflation regime. The calm verdict is that oil and the dollar are not contradicting each other. They are pricing different horizons. Oil reflects the shock that is happening now, while the dollar reflects how quickly the Fed is expected to answer it. Price is the surface, but policy timing and liquidity expectations are the message. Until those clocks align, neither a Fed pivot nor a lasting inflation breakout has been confirmed.